Bye-bye.
All right, so CPI was up, and that's what caused the market to fall so much yesterday. The number 2 factor, okay, S&P 500 was down yesterday a lot. It's down year-to-date 18.6%. And so there's a lot of people questioning what else is going on. Number 3, the VIX, the volatility index, was up yesterday 6%, 27.75, which means that's going to create even more havoc. Number 4, next week, the May producer price index. So Friday was consumer price index up. May's producer price index will be out next week, and if that's negative, it could cause another downturn.
It could, and this is where the Fed needs to step out in front and quit doing these tiny little incremental increases.
That was my next point.
Was it?
Fed more rate hikes or larger rate hikes. There are some calling for a 0.75% rate hike the next time, which also causes the market to go down because people are concerned about interest rates going up and not slowing the economy. It's like a double-edged sword. Number 6, retail sales report next week. I'm expecting it to be ugly. Walmart, Target, and Dollar General are having a really hard time with supply chain. Target is discounting tons of stuff just to get rid of it because people aren't buying the same stuff they were buying during COVID, and they stocked up on the wrong things, or they can't get the right stuff out of China or wherever.
Well, inflation's kicking in, and people are feeling it between the pump and their groceries, so they're not going to go out and buy the big ticket items, and that's a lot of what Target and Walmart are offloading to companies like TJ Maxx and Ross. And
so it might need be a good time to buy a new flat screen TV. Well, I haven't looked at the prices because that's what they say. They're loaded up on them, and people aren't buying them.
I can't believe I'm diverting here a little bit, but I walked into Sam's yesterday, and they have these. The first thing you see is all the televisions, and there are 60 and 70 and 80-inch televisions for $1,000. I mean, think about what that would have cost just 5 years ago.
Okay, next one, GDP in July will determine whether we're in a recession. So we don't know that until next month, but people are making the call for it, and I have a bunch of articles about that. And then number 8, Wall Street Journal had a really good article this week. Global companies have racked up more than $59 billion in losses from the Russian operation from leaving.
That's right.
About 1,000 Western companies have pledged to exit or cut back operations in Russia. McDonald's expects a loss of $1.2 to $1.4 billion after agreeing to sell its Russian restaurants to a local licensee. Exxon has lost $3.4 billion. And then there was this massive list, which I'm not going to go through all of it, but $59 billion is not a small thing to happen from this one Russia-Ukraine deal.
Trickle down, Sherri.
Now, there's a phone call? Oh, great. Hey, good morning. You're on with Randy and Sherri.
Yes, how are you doing this morning?
We're very good.
Good morning.
Yeah, this is Robin from Perry, Georgia, and I just want to say about the inflation. As far as we're going to, I know Joe Biden said yesterday his son was making more profit than God. And, of course, we know God owns everything. But as far as these companies and these executives making all this big profit during this time of what's so-called inflation, is that they need to start locking up these big executives.
No, that's not what needs to happen. I mean, why don't you go to a country that operates that way and see how you like it there? Because that's not how free enterprise runs. And matter of fact, the government has provided so much free money to the Americans that has allowed the profits that they're getting today is directly because of all the free money that the government just gave out.
And that's not true either.
It is true.
I'm getting tired of y'all Republicans.
Stop it already. We're done.
We're done.
Sorry.
Good night.
Anyways, so mortgage demand falls to the lowest level in 22 years amid rising rates and slowing sales, and you pretty much already covered that, so I don't need to talk about that. Some economists predict the Fed will hike rates as much as 0.75% next week. And so that's the other thing, the factor that's laying out there. All of this, there's a lot of stuff going on at the same time that creates tons of volatility. So if you're in a buy and hold portfolio, or just hang in there. We've moved mostly out of the market about 3 weeks ago because of all this stuff that was coming down the pipeline and what was happening back then. But I had a lady in my office this week and she has an IRA, and it's down. And there's nothing wrong with the holdings. It is just down, and she's not taking money out, and she doesn't need the money now. But she was just extremely stressed out looking at it. And if you can just ignore it for now and let it go, because we don't know how long this is going to last. We don't know if this is temporary. There are still people out there thinking that we're going to have a good fourth quarter.
Yep.
And the news is all over the place. There's no agreement on where this is all headed. So here's an article from the Wall Street Journal. The recession will hit in the first half of 2023, and the Dow is headed lower. Oh, no, this is CNBC. Many economic prognosticators and Wall Street stock pickers have made it clear where they stand on inflation and the Federal Reserve policy response. The economy and markets will get worse before they get better. Many chief financial officers at top companies agree with them, according to the results from the latest CNBC Certified Financial Officer Council survey. Over 40% chief financial officers cite inflation as the number one external risk to their business, and going deeper into the results from the Q2 survey, the links between geopolitics and food and energy prices and inflation are clear. Almost one quarter, or 23% of CFOs, cite Federal Reserve policy as the biggest risk factor. Additional CFOs cited supply chain disruption, that was 14%, and Russia-Ukraine war specifically as their number one business risk. CFOs are not uniformly of the view that the Fed won't ultimately be able to control inflation. A little over half, or 54%, express confidence in the central bank, but that's still not enough to alter their view of where current economic conditions and policy decisions are headed, into a recession. So these were 22 chief financial officers at major organizations that were interviewed by CNBC. Growth prospects for the U.S. economy and global economy have dimmed. According to them, the Atlanta Federal Reserve GDP Now tracker's most recent forecast for growth issued this week was a negative revision and indicates the economy could be headed for a second consecutive quarter of negative growth. And everybody's, depending on who you read, so these guys are all thinking that we're going to be in a recession next month. And they expect, 77% of the CFOs expect the Dow to fall below 30,000 before setting a new high, which would be a 9% of over 9% from its current level. Let me see if there's anything else in here that's worth reading. Twice as many CFOs, 36%, say they will increase their spending. See, this is ironic. Okay, this is twice as many CFOs, 36%, say they will increase their spending over the next year, then decrease,
right,
while almost half say they will at least maintain current spending levels. And firms are still in hiring mode, with more than half saying headcount will be increased over the next 12 months.
What they're doing is they're looking at the long-term
projection. Yes.
And that they realize that what we're seeing now is just turbulence.
Yep, lots of really good word for it. Do you want to cover this next one?
No, please do. I don't have my glasses. It makes it very difficult.
Gosh. The spending spree continues, and this is from a company that we subscribe to. It says, if you had to choose one, and this is the other alternative viewpoint, if you had to choose one indicator to predict the direction of stock prices, you should focus on consumer behavior. That's because consumer spending makes up 70% of our economy. Today, most folks are pessimistic about the U.S. consumer. The sugar rush from 2020 and 2021 stimulus checks are starting to wear off. And with prices at the pump and prices of everything else at highs, it's a drag on the economy. The average American is terrified of a recession. A recent Quinnipiac University poll found that 85% of Americans think we're going into a recession over the next year. We're not as pessimistic, though. While consumer sentiment, and I've been reading this guy for years, while consumer sentiment is down, spending is still high.
That's right.
According to the U.S. Bureau of Economic Analysis, consumer spending was 9.2% higher in April than a year earlier. A few factors are spurring consumers to spend. First, we're in an incredibly strong labor market. These dynamics have driven wages 5% higher than they were a year ago.
But, that's why the Fed is having such a hard time, is because there's a lot of money still sitting in
people's bank accounts.
People's bank accounts. I think they're estimating
the bank doesn't want you to get out.
Right. I think I read yesterday it was about $1.9 trillion that is still yet to be spent. And you have full employment, essentially. And so people are able to job hop, like we keep saying our daughter does. And so that makes it very difficult for the Fed, high employment and a lot of savings built up.
Right.
Because their spending is just still there. And that makes it very difficult for the Fed to get a soft landing out of this.
So the second reason that consumer spending has remained strong in the face of record inflation is that folks have been dipping into their savings and using their credit cards. This may sound like bad news, but the fact is that folks had plenty of money saved up while COVID-19 shut down the economy. That led to a $2.5 trillion in extra savings between March 2020 and January 2022. Folks are starting to use the cash pile. This makes sense. People want to get out of the house. They want to travel. In fact, all my clients are just now starting to book trips and go places.
And you just booked our trip to Idaho, and normally we're able to hop on a plane, get up there for under $1,000 for both of us.
Well, here's the real
and rent a car, and normally we stay with one of their relatives up there. But what did you have to pay for airfare and a rental car combined?
So I have a Southwest Airlines card that I use for business stuff and have points. So we fly to Colorado for free every time we go because of the points on that card. I use a Marriott card for my other Visa card so we can stay at hotels for free.
Right.
So, and I had Delta points, and I had a free companion certificate. So I'm all excited to get in there and go book this and have a free flight, thinking I'm going to get a bargain because that's what I am, bargain shopper. And because I put in the companion certificate up front, and it wanted me to take horrible flights. It would not let me take a nonstop flight with that companion certificate. It was making me take a flight with layovers that would take 11 hours to get there.
Jeez.
And it's a 4-hour flight.
Yeah.
There were only 2 direct flights that I could get, and I had to pay for them, and I couldn't use points or the certificate, which made me so angry that I'm going to call and complain to Delta. I don't understand why. What's the point of even giving me that certificate if it's useless? Because I used to use them every year because I get one every year. So I get in there, and I had no choice but to book the round trip straightaway flights that are 4 hours long, $2,000. And we're going to be out there for 3 days. $2,000, and there was no alternative to it. And let me see. So then the car is just a cheap piece of junk car, $150 a day. And then the only blessing is I went to look for a hotel. The place we wanted to stay was $440 a night that's on the lake. And so I started looking at bed and breakfast and other stuff. And then I got my Marriott points out, and I was able to book a 5-star Marriott that is not downtown where we wanted to be, but it's close enough, and who cares at this point. And I used my points, and I had a free night and enough points to buy the other Thursday, Friday, Saturday, Sunday. So yeah, I had a free night coupon certificate in my Marriott account, and I had enough points to pay for the other 3 nights completely. And I paid for trip insurance to get my money back in case we cancel this trip for some reason. It was only $7. So I paid $7 last night to stay in a Marriott that's $440 a night.
At least that offset the other stuff.
Yeah, then I went to bed feeling a little better. But that Delta flight really ticked me off that I couldn't use my certificate to just have a normal flight. So, yeah, and they say in here that it is, the prices have gone way up. So households are also tapping their credit cards. Over the past few months, total consumer credit is approaching the pre-pandemic trend.
And if you're using your credit cards, that's not a bad thing to do. Just, hopefully you're paying them off every month.
Right.
Because that carried balances, the interest will just eat you up.
Yep. So that's what I do. I put everything on the credit card and pay it off at the end of the month and get the points. Eventually, if consumers continue to drain their savings and load up on credit card debt, they will be in trouble. A day of reckoning will come, but we're a long way away from that today. Things are just getting back to normal, and we think we're close to peak inflation, so pressures on costs should ease. We disagree with the majority of the population that the U.S. is going into a recession this year, so all of that fear gives us a tremendous buying opportunity. So this is what you're dealing with in this business, is you're dealing with smart people that have completely opposite perspectives of the same data.
That's right. But let's just say inflation is affecting you now. The things that you can do first would be to create a budget and track your spending. Sherri's often talked about tracking your spending and doing it on a yellow piece of paper versus a spreadsheet, because it lays on the counter so you can see it every time you walk in the door. And when you come in, write everything down that you spent that day. And then analyze the spending and cut the items that are wants or nice to haves versus essentials.
Or go to generic.
Well,
look at options.
Yep. And that's what I was going to say. And shop smart, Costco, Sam's, online deals, Ross, TJ Maxx, things like that. Because my hope for you is that when the inflation is over, you're not still having to deal with it 5 years down the road by paying off high interest rate credit cards.
Yes.
So.
What else?
That's it.
Okay. So here's a perspective. This is an article from Investment Advisor magazine. So Jeremy Siegel is Senior Investment Strategy Advisor at Wisdom Tree, Professor of Finance at the Wharton School of the University of Pennsylvania, and Bob Dahl, Chief Investment Officer of Crossmark Global Investments. So these are two smart people that are in this all day long. Here's what they say. What we can expect through the rest of this year is a tug of war between earnings tailwinds and valuation headwinds. And that's Dahl speaking. Here are a few key points from these two economists. 1, there won't be a recession this year. Despite understanding why some are afraid a recession is possible this year, Siegel said he still doubted that will happen. The Fed was slow to catch on to inflation, and they likely will be forced to overreact to it and then be slow to change when we get to a slowdown. But at a minimum, the Fed needs to get to a neutral policy rate. I emphasize again that I do not see a recession this year. Dahl echoed these views. This is a year when you're going to frustrate both the bulls and the bears. A recession anytime soon is not likely, he predicted, noting that the job market is strong. 2, the S&P 500 may not experience a deep bear market. Growth stocks continue to come under enormous pressure during earnings season as questions mount on the sustainability of earnings, supply constraints, and other margin pressures, Siegel said. He pointed to the April sell-offs in Amazon, Alphabet, Google, and Apple, which followed the halving in prices we had in Facebook and Netflix. He also predicts that financial and energy stocks will outperform. Number 3, the final Q1 GDP figure may end up not being negative. This is very interesting.
It is.
So nobody else is saying this. This quarter 1 GDP is a preliminary GDP release that could be revised substantially higher, which is a game changer. Number 4, there won't be 2 straight quarters of GDP declines. The outlook for second quarter GDP is much better and currently forecast at plus 2%.
That's good. That's
Number
very
6, there will probably be additional labor cost pressures, which of course because wages are higher. Skipping number 7, there are reasons to be upbeat and downbeat about inflation for the rest of 2022. Number 8, 10-year Treasury will see a year of negative returns unless we can repay the debt. And so there was a really good article last week, and I think we talked about it, about the amount of taxes that were paid first quarter to the government was the highest ever. It was a record breaker. And so the government has already collected more money back than they expected to get, which could offset some of the debt that we've gone into. And that's the positive. That's one of the positives of this first quarter.
And before we go on, you're listening to Your Money with Randy and Sherri Goss. We're the Rosenberg Financial Group. And what we do is manage your money for retirement. If you'd like to come see us for a complimentary consultation, give us a call at 478-922-8100. And, if you're looking for good articles and, to help you down your road, your investment path, take a look at our special reports. There's about 15 different really good ones out there. And, like I said, if you need to come see us, call us, set up an appointment. It's free. 478-922-8100.
And one of the special reports I like in particular is Can I Afford to Retire?
Yes.
Because it walks you through all the steps that I would take if you came to see me in person. Is exactly what I do. We look at your income, your assets, your debt, your timeline, your future pension, Social Security. We lay all of that out, and I write it all down on a piece of note paper. In about 50 minutes in an appointment, we can get to the bottom of can you afford to retire or not. And I've had people in my office that I've had to say, sorry, but you got to pay off this debt first because you can't live on this income and have these debt payments. Or maybe you need to work a few years longer to increase your pension amount. I mean, there's all sorts of variables that go into this, but that special report, Can I Afford to Retire, walks you through all of it. And at the very end, there's a spending tracking sheet so that you can actually put it on the countertop, come home every night, write down every dime you spent that day, whether it was a charge card usage or cash or what, auto direct deposit or direct pay or online pay or whatever.
Right.
You write it down so that your brain actually recognizes that you spent money. The problem we have today is everybody swiping debit cards. And this is a problem that both of our kids went through because they got iPhones, and while they were in high school, they had cell phones, and they had a debit card. and they never had to use a checkbook ever. And so our daughter, they would go on their phone and look at the balance at the bank, and that's how much money they knew they had to spend. Well, that is not a great way of managing your money, because you can afford to go to Starbucks, but should you even be in Starbucks? I mean, that's the question. Should that $5 or $7 be going somewhere else?
But I will tell you that, I remember back when I was, 16, whatever, I got my first checkbook, but I got no training on how to do this.
Right.
So I bounced checks all over the place,
Oh my gosh.
I wasn't keeping the register. So we're going to talk about this in an upcoming show, but how
you're the reason that Georgia just passed the rule that there's going to be mandatory financial education in high school going forward.
Probably. It just took them 40 years to get there, But we're going to talk about this in an upcoming show on how to deal with your teenagers and help them become more financially savvy in their life.
We should write a special report on that. That'd be really good to hand out to people that come and see me who have kids. So U.S. retailers cut prices, but services keep inflation hot. Major U.S. retailers like Target and Walmart have been cutting prices to clear overstocked warehouses, which I mentioned earlier.
Yep.
But hotel revenue is pouring in as daily room rates and occupancy have broken above pre-pandemic levels. Used car prices are no longer surging at the chart-topping pace, but airline fares as of April were rising at a stratospheric 33% annual rate. The price of restaurant meals is accelerating, but with no break apparent yet in demand. For the Fed, as well as Democrats worried about inflation will cost them at the midterm polls in November, the great rotation so far is providing no easy fix. Shipping costs and port backlogs are easing. Supply chain indices from both the New York Fed and Oxford Economics eased through May, but services are taking up the slack. Excluding energy-related services, inflation for core services has accelerated for 8 months. Overall, we remain cautiously optimistic for the consumer. For politicians, $5 gas during the summer driving season ahead of midterm congressional elections is painful. I can see that.
Yep.
So we're going to talk about energy next.